Right now, COMEX silver open interest typically runs 200,000 to 300,000 contracts, each representing 5,000 ounces. That's over 1 billion ounces of paper claims against 415 million ounces of total COMEX stocks, only 113 million of which is registered. If registered inventory keeps dropping while open interest remains elevated, the conditions for a delivery squeeze build, maybe not tomorrow, maybe not next month, but the structural vulnerability grows with every withdrawal. Here is how this ties to the broader macro picture. Central banks around the world have been buying gold at record pace. The World Gold Council reported central bank purchases exceeded 1,000 tons in 2023 and remained strong through 2024. Why? Diversification away from dollar-denominated assets and protection against currency debasement and geopolitical fragmentation. Silver is often called gold's little brother, but it's arguably more strategically critical because of industrial applications. You can't build solar panels, EVs, 5G networks, or advanced weapon systems without silver. Gold is mostly monetary or jewelry. Silver is both monetary and irreplaceable in critical technologies. So when Shanghai buyers bid $15, $17 over COMEX for a metal essential to their industrial base, this isn't TA market anomaly. It is a signal that physical availability at current prices might be a strategic concern. China thinks in decades, not quarters. The Belt and Road Initiative, long-term acquisition of African mining assets, patient accumulation of gold reserves. If Chinese state-owned or strategically aligned private companies are securing silver supply chains ahead of potential disruptions, a $15, $17 premium is a rounding error compared to the cost of halted production lines. If this is the early stage of a strategic commodity being recognized as scarce, then the bearish delays previously outlined become temporary speed bumps, not a refutation of fundamentals. Here's what I'm watching in the coming weeks. Shanghai premiums. Do they compress to historical norms, $2 to $5, or stay elevated or even expand? Sustained $15+ premiums are a red flag for persistent physical tightness. COMEX withdrawals. Does this pace continue, or was this week an anomaly? Another 500,000 to 1 million ounces leaving registered inventory would make the math for shorts increasingly uncomfortable. LBMA inventories, drawdowns in London would suggest that physical tightness isn't just a China story. It could be global. ETF flows. Significant inflows into physical silver ETFs like SLV or PSLV, coupled with COMEX declines, would further tighten the physical supply pool. Technicals. If silver breaks overhead resistance despite bearish narratives and paper selling, it signals that physical demand is overwhelming manipulation. The setup mirrors Mark Douglas's framework in trading in the zone, two conflicting beliefs. Paper traders and bullion banks assume silver is abundant and prices are controlled via futures. Physical buyers in Shanghai and elsewhere believe the metal has strategic value exceeding the paper price. When these belief systems collide, one breaks. Current data shows the physical side gaining strength while the paper system shows stress. Not an immediate collapse, but rising vulnerability. What does this mean for holders or potential accumulators of silver? Long-term stackers. If you believe in a structural deficit, this week's data validates that thesis. $15, $17 Shanghai premiums and million-ounce COMEX withdrawals are signs that physical is separating from paper. Short-term traders. Paper COMEX prices can still be manipulated, but they're increasingly disconnected from physical reality. When the disconnect grows too extreme, price will realign with physical fundamentals. If you're waiting for a pullback, ask yourself what kind of pullback makes sense when Shanghai bids $15 to $17 over COMEX, while vaults are being drained. Paper dips might happen, but physical premiums could widen, meaning your effective acquisition cost won't drop as the COMEX chart suggests. Healthy skepticism is fair. This market has a history of price suppression and frustration for physical holders, but intellectual honesty requires acknowledging when the data changes. This week, the data changed. 3 key takeaways. The $15, $17 Shanghai premium represents a potentially persistent divergence between physical and paper pricing, undermining COMEX's price discovery function if sustained. Nearly 1 million ounces leaving COMEX, registered inventory in a single day, concentrated in major bank vaults, shows holders prefer possession over warehouse convenience. Elevated physical premiums, declining inventory, and robust industrial demand create structural conditions for a potential supply squeeze if current trends continue. The unresolved question: can bullion banks generate enough paper selling pressure to break Shanghai S-resolve and compress the premium before COMEX inventories become critical? If yes, this becomes another chapter in the story of paper market manipulation temporarily suppressing physical fundamentals. If no, if Shanghai holds above $125 and continues bidding regardless of COMEX action, we could be witnessing the early stages of a regime change in global silver pricing. This isn't advice, it's analysis. The decision to act rests on your research, risk tolerance, and financial situation. The purpose here is to connect the dots, ask questions mainstream media won't, and present the data clearly. Verify everything yourself. Watch Shanghai, monitor COMEX, track premiums, and make informed decisions based on facts, not hype. Invest with logic, not hype. OG John AG here. Let's talk about the silver market this week and why the developments have me genuinely concerned for the bullion banks. The data I've been cross-checking over the last 48 hours is that significant. Shanghai silver is holding around $125 to 127s, not 122s, not 123, 125 to 127. At the same time, the COMEX premium, the gap between physical silver in China and paper pricing in New York, is sitting at 15 to 17 per ounce. Let that sink in. Under normal circumstances, a $15 to $17 premium would trigger arbitrage. Buy COMEX paper, ship physical to Shanghai, collect the spread, free money. But this time is different. China isn't following COMEX lower. Physical buyers in the world's largest manufacturing economy are bidding $127 and refusing to budge. Meanwhile, COMEX is hemorrhaging physical metal. Depository reports from January 26 tell the story. Asahi registered vaults, 27,691 ounces out. Brinks, $55,756 ounces out. CNT, net withdrawal of 133,000 ounces. Delaware, just under 1,000 ounces. HSBC, 615,000 ounces withdrawn in a single day, plus 103,854 adjusted out from registered JP Morgan, 210,000 ounces out. MTB, 72,462 ounces withdrawn StoneX, 167,047 ounces withdrawn total. COMEX registered silver dropped by nearly 1 million ounces in just 24 hours. Registered plus eligible now sits at 415,000 to 241,837 ounces. Connect the dots. Shanghai physical premium $15 to $17. COMEX registered inventory bleeding. China refusing to follow the paper price lower. What you are witnessing is a market recognizing that physical silver has a different value than paper contracts. Historically, as Jesse Livermore noted, market patterns break down when fundamentals stop driving price the way they should. That $15 to $17 premium is exactly that, a breakdown of expected mechanics. Normally, arbitrage would close the gap quickly, but what happens when the metal required for that arbitrage is being withdrawn instead of deposited? When Shanghai buyers are securing supply for industrial use that can't be delayed, you get a divergence between paper pricing and physical reality. COMEX inventories start bleeding because holders realize having the metal in hand is worth more than leaving it in a warehouse. Technically, silver has been consolidating on the daily chart, testing support levels in New York. Down-day volumes are light, up-day volumes, particularly short covering, are heavy, a bullish divergence. The RSI on the 4-hour chart isn't entering oversold territory, indicating selling pressure lacks follow-through. The commercial short positions from bullion banks remain elevated, significant, though not extreme. Yet these are the same institutions fined hundreds of millions for spoofing in the past. Macro factors amplify this. China has been systematically building strategic commodity reserves for over a decade. Export controls on critical metals, documented gold accumulation, and now refusal of physical silver to follow. COMEX lower suggests industrial and strategic buying ahead of potential trade disruptions. Chinese industrial buyers, solar, electronics, EV batteries, are securing supply, not speculating. Meanwhile, the U.S. is reshoring critical supply chains. The Inflation Reduction Act incentivizes domestic solar production. Every panel requires silver. Global mine supply has been flat or declining for years, constrained by the economics of base metals. Industrial demand is exploding. Solar PV consumed 140 million ounces in 2024 alone, along with EVs, 5G, AI data centers, and defense applications. Stagnant supply meets accelerating demand, creating regional premium dislocations while the paper market suppresses pricing. That $15 to $17 Shanghai premium is no anomaly. It's a signal. There are reasons this might not immediately become a COMEX delivery crisis. Eligible COMEX inventory totals over 300 million ounces. CME mechanisms can manage delivery squeezes. The Shanghai premium could compress if demand moderates. Technical resistance and dollar strength could weigh on price, and markets can remain irrational or manipulated longer than expected. But here, it's what changes the calculus. Every bearish delay assumes physical supply is sufficient to meet demand. That $15 to $17 Shanghai premium combined with nearly 1 million ounces leaving COMEX vaults in a single day suggests that assumption may be failing. If US, European, or Indian buyers start securing physical silver regardless of price, and COMEX warehouse receipt holders perceive counterparty risk, withdrawals accelerate, inventory shrinks, delivery concerns rise, premiums widen. A feedback loop. We've seen this before. Rhodium in 2020, 2021, palladium in the late 2000s, even crude oil during the Cushing storage crisis. When physical availability constrains paper contracts, the futures market loses price discovery. Jim Rickards warned that assumptions about always available physical supply are fragile. That assumption is being tested in the COMEX silver market right now. Here are the concern for bullion banks. Shanghai holding above $120,000 while COMEX paper lags leaves short sellers exposed. They can't deliver physical metal being withdrawn. Arbitrage can't compress the premium if metal isn't available. Shorting forever is impossible if the cost of carry escalates due to persistent backwardation or widening premiums. London SLBMA has already shown stress with periodic backwardation. Near-term physical trading at a premium to deferred contracts. That's the opposite of normal market structure and confirms physical tightness. Shanghai's $15, $17 premium to COMEX isn't noise. It's a signal. They're part of a pattern. Let me walk you through a scenario, not a prediction, but a possibility based on current trajectories. If Chinese demand remains strong and Shanghai premiums stay elevated, arbitrageurs and industrial buyers will continue pulling metal from COMEX vaults, the most liquid source of supply available to them. As registered COMEX inventory declines, the ratio of open interest to available physical metal starts climbing.